In this video, we're going to talk about the forward contract. Now, we've already talked about the forward contract when we were deriving the forward price. And the forward price is the price at which a forward contract can be agreed, and it's fair as in it has zero present value. But forward contracts don't have to have zero present value. So a forward contract, as we just said, should have zero present value if it is agreed at the fair forward price. Now, the fair forward price depends on the market. And after a contract has been agreed, the contract value may not stay zero. If, let's say, we've gone long a forward contract at the fair forward price, and the fair forward price goes up significantly from now, well, that contract is no longer worth zero. We're actually quite happy we agreed at a lower price than what would currently be seen in the market at zero present value, which means it has a positive present value to us. Alternatively, the fair forward price falls in the market and we've agreed at a higher price. We're unhappy, which means it has a negative present value to us. And if it has a negative present value to us, it has a positive present value to our counterparty. Now, imagine the following scenario. We've entered into a forward contract at some price, and we decide later that we want to unwind that contract. We want to close it out. We call up the counterparty, and say, hey, let's get rid of this contract. If the contract has a positive present value to our counterparty, they're going to expect to be paid to tear up the contract. Equally, if it has a positive present value to us, we would expect to be paid as well if we were going to tear up the contract. So the present value matters. Now, we want to find the value of a forward contract with any strike. It could be a contract that we agree to now. So we agree to a contract where the strike price is not the fair forward, or it could be a contract we entered into some time ago, and then the strike price is unlikely to be equal to the fair forward price. So let's set some notation. So let's have a forward contract. K is going to be the delivery price, or the strike price. T is the maturity of the contract. F is the fair forward price, and R is the risk-free interest rate. Again, we're not going to assume that K equals F. And if K equals F, we know the value of the forward contract anyway, so we don't need to do any work. We know that value is zero. Okay, so let's work through our arbitrage arguments. The first arbitrage argument, we're going short the forward contract with strike K. So we agree to sell the stock forward at time T for K, and we receive some amount of money X to enter into the position. Now, I've written this as receive X, but it could be that we receive negative 12. X is negative 12. If we receive negative 12, that means we had to pay. So I'm not making an assumption that X is positive here. Now, we can also enter into a forward contract on market, as we'd say, for F, the forward price. So we agree to buy the stock forward at time T for F. That doesn't cost us anything. Now we're going to invest X at the risk-free rate R. It could be, again, if X were negative, we're borrowing X, but I'm going to call it X, investing X. So we wait until the maturity of the contracts. We buy the stock and pay F, that's that second contract. We sell the stock and receive K, that's that first contract. We redeem our investment for X equal E to the RT. Again, that could be a negative number, in which case we have to pay it. For there to be no arbitrage, though, the money we receive has to be less than the money we pay. Or K, we received that, plus X e to the RT, we received that, is less than or equal to F, the amount we paid. Okay, so that's our first arbitrage argument. The second one's similar. We agree to buy the stock forward at time T for K and pay X. We agree to sell the stock forward at time T for F. We borrow X at the risk-free rate. Again, it could be that we're investing negative X. Just depends. We're using terminology here. At time T, we buy the stock. We pay K this time. We sell the stock. We receive F. We repay our borrowing, X e to the RT. And again, the money we receive has to be less than or equal to the money we pay. K plus X e to the RT is bigger than or equal to F, which means K plus X e to the RT has to equal F, the combination of those two arguments. Do a little bit of rearranging, and we end up with x equals f minus k e to the minus rt. So the price, the fair price of this contract, with strike k, not strike f, is x equals f minus k e to the minus rt. So that leads to the following result. The present value of being long a forward contract, long meaning you're going to buy, is f minus k e to the minus rt. If we're short the forward contract, we're selling, it's just the opposite, k minus f e to the minus rt. If we're buying n units, n could be positive or negative, the present value is n times f minus k e to the minus rt. So that's how we value a forward contract in general. And it's pretty straightforward, right? We need to know f. We're assuming here we know f. And again, we know some ways to calculate f. We'll learn some other ways. But the present value equals n times f minus k e to the minus rt, where n is the number of units of the asset, number of shares, for example. F is the fair forward price. K is the price we agreed. R, risk-free interest rates. T, maturity of the contract. And notice, if K is bigger than F, so we agreed to buy it for something, let's say we're long, we've agreed to buy a share for more than the fair forward price, that has a negative present value to us. That's okay, as long as when we enter into that contract, if I'm entering into a contract with a negative present value, I would expect to be paid. If K is less than F, I'm happier, I have a positive present value, but in order to enter into a contract with a positive present value, my counterparty has a negative present value, and they would expect to be paid to enter into that contract. Let's do a few examples. So the first example, a stock is trading at 95 and risk-free interest rates are 2%. You are long a forward contract with a strike of 97 that matures in 2 years. So what is the present value of this contract? So the first thing we have to do, I've lost my pen. Found the pen. Okay, the first thing we have to do is find the forward price. So F equals S e to the RT. So F equals 95 e to the RT, e to the 0.02 times 2. Let's bring up a calculator. So we have 95 times 0.04 e to the x, 98.88. So the forward price is 98.88. 98.88. We're long a forward contract with strike of 97. So the present value is simply, it looks like we're buying one share, so we'll do 1 times the forward price, 98.88 minus 97. And we discount that, e to the minus 0.02 times 2. So that is 1.88 e to the minus 0.04. Let's grab our calculator again. 1.88 times 0.04 plus minus second e to the x equals 1.81. So the present value is 1.81. So we're just using our formula. The second example, a stock is trading at 65 and the risk-free interest rates are 4%, and you're long a forward contract with a strike of 68 that matures in 6 months. So this is similar to the previous example. So the forward price is 65 e to the 0.04 times 0.5, just 65 e to the 0.02. And I'm just going to leave this like this for a second here and just show a little trick here. So the present value of the forward contract, we're long, is f minus k e to the minus rt is equal to 65 e to the 0.02 minus k, the strike was 68, e to the minus, and again, 4% times 0.5 is 0.02, so 0.02, and so that's 65. The e's cancel. The e to the 0.02 times e to the minus 0.02, that's e to the 0, which is 1. 65 minus 68, e to the minus 0.02. Now that trick works because the forward price, S e to the RT, that trick doesn't work for more complicated forwards. So now we grab our calculator again, and we do our calculation. 65 minus 68 times 0.02 negative e to the x equals negative 1.65. So our forward contract in this case is equal to negative 1.65. A forward contract can have positive present value or negative present value depending on whether the asset has moved up or down and what changes to the forward price have occurred. Okay, third example. The stock is trading at 75 and risk-free interest rates are 3.5, and a client approaches a dealer and asks for a two-way bid and ask price for a 6-month zero-cost forward contract. The dealer wants to make 50 cents up front, irrespective of whether the client goes long or short. So what strike price does the dealer quote? Okay, so we know from the dealer's perspective, he wants to make 50 cents. If the client goes, let's say the client's going short. Let's start with that one. The client's going to go short. If the client goes short, the dealer goes long. If the dealer goes long, if the dealer goes long, we need 50 cents to be equal to F minus K e to the minus RT. Right? So the dealer needs to make 50 cents up front. 50 cents is equal to F minus K. That's the present value. F minus K e to the minus RT is the present value of the contract. Client goes short, dealer goes long. So let's look at this for a second. We want to find out our strike. So multiply both sides by e to the RT. So 0.5, the profit, e to the RT. We're growing our profit to the maturity of the contract equals F minus K. So K plus 0.5 e to the RT equals F, or K equals F minus 0.5 e to the RT. So we have the strike equals the forward price, the fair one, minus the 50 cents profit grown to the maturity of the contract. Okay, we need to, and the other, so that's if the client wants to go short. So this is client short, which is the same as the dealer goes long. And the alternative is the client is long, which means the dealer goes short, which means that the 50 cents is equal to K minus F e to the minus RT, and we go through the same thing and we get K equals F plus the 50 cents e to the RT, the 50 cents grown to the maturity of the contract. So in order to find out the strikes at which the dealer is willing to enter into a zero cost forward, either direction, we want to find out the bid and ask strikes, we need the forward price and we need to know what the 50 cents is grown to the maturity of the option. Well, the forward price is, I'll write it up here at the top, F equals 75 e to the 0.035 times 0.5. So let's do that with our calculator. Pull the calculator out. 75 times 0.035 times 0.5 e to the x. 76.32 is the forward price. And the 50 cents grown is going to be 0.5 e to the 0.035 times 0.5 equals, pull the calculator out, 0.5 times 0.035 times 0.5 e to the x, 51 cents. 0.51. So we've got to do 7632 minus 51. 7632 minus 0.51, 7581. 7581 versus 7683. Okay, so the dealer is going to quote these two strikes. The dealer is happy to enter into the contract. Client wants to go short. They're going to receive 75.81. The dealer will pay 75.81 for the share. Client wants to go long. Then the dealer is going to receive 76.83 when the client buys the shares. Client can't make money. No free money here. The dealer always makes his profit. What's his profit? 50 cents no matter what the client does. Now for our last example where we pull all of this together. A stock is trading at 85 and risk-free interest rates are 1.75%. A dealer sells a 1-year forward contract to a client and makes 50 cents up front. Now remember, in the previous example, no money changed hands, right? These were zero cost transactions. So the dealer is making 50 cents, but it's not like he has 50 cents in his pocket. He's got to earn that 50 cents. So what transactions does the dealer enter into to lock in their profit? So let's first figure out at what price they traded, and then we'll figure out where the 50 cents comes from. Okay, so stocks trading at 85, risk-free interest rates are at 1.75%. Remember, the dealer goes short at the strike F plus the profit, 0.50, E to the RT, the profit grown to the maturity of the transactions. So that's equal to 85 E to 0.0175 times 1 plus 50 cents, 0.5, 0.5 e to the 0.0175, which is 85.5 e to the 0.0175. Let's grab our calculator and figure out what the strike price is on this contract. So we have 85.5 times 0.0175 e to the x, 87.01. Okay, so the strike price is 87.01. So that's our strike price. Now let's go through our contract carefully. Now I'm going to assume we don't trade there's no other forward contract to trade at because this is a dealer. He could trade with other dealers, but he gives up his profit. So he's going to do the hedging transactions. So today, what does he do? He has sold, so he is agreeing to sell. So he's sold forward contract with strike 87.01. Maturity is 1 year. Okay, no money changes hands. What does he do? If he sold the forward contract, it means he's selling the stock in the future, price of 87.01, which means he needs to buy it today. So he borrows 85 at 1.75% and buys stock. That was easy. Let's go forward 1 year. A is not very good. Okay, there's 1 year. So now what happens? He owns the stock, so he sells the stock for 87.01. So he receives the 87.01 and he has to repay. How much does he have to repay? 85 e to the 0.0175. So that's how much? Let's just check that. I'll get my calculator out again. 85 times 0.0175 e to the x, 86.50. So he has to repay 86.50. Profit, the money he's made, guaranteed, 0.51, which is equal to 0.5 e to the 0.0175, right? His profit at the maturity of the transaction is the 50 cents grown at the risk-free rate. His profit at the beginning of the transaction is, of course, the 50 cents. So basically, through these transactions, the transactions which are the basis of the arbitrage arguments, this dealer, can trade in such a way that they are guaranteed the profit.